Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Stocks across the Asia-Pacific under pressure. That's after bad loans at two U.S. regional banks, sparking worries about the credit market.
TSMC raising its revenue outlook for a second time this year, signaling confidence in AI demand. Wedbush Securities Dan Ives joins us live in the next hour to discuss why he remains bullish despite rising fears of a bubble.
Also coming up here on exclusive with Alibaba Group Vice President Kaifu Zhang on plans to deploy Gen AI across its e-commerce platform.
Plus, we take a close look at how China's export controls on the rare earth supply chain risks a global backlash.
Good Friday morning. We start off the show with a breaking scoop that's really switched things around for shares at Nintendo, erasing the earlier losses. As you can see now, we're up about 1.5%. Our sourcing has effectively learned that Nintendo is planning to massively ramp up its production. We're looking at 25 million Switch 2 units by the end of the first calendar quarter of next year. Let's flip the page, please, and have a look at how that's playing out across the regions. Most are still down, in fact, as we speak. Taiwan is coming online, and within that market, of course, TSMC first reaction to the Taiwan-listed shares on the earnings, which came through yesterday. We're down about 1.7, which is fairly consistent with the move that we saw roughly with the U.S. listing overnight. Nikkei's off about 0.8 of 1%. U.S. futures are continuing to see a slide, and this is really something you don't normally see this time of the day on U.S. futures. Flip the page, please, and we'll get into the U.S. regional banks issue in a moment here. Dollar is on track for the worst week since July. Interesting, though, is we're still in the shutdown. We still don't have data, but we've fully priced now, as far as rate markets go, a rate cut at the end of this month. And just on that very note, the two-year yield has now touched the lowest since 2022. The other story, of course, is with gold, silver, precious metals. And as you can see, we're just about $30 now from hitting that 4,400 milestone on gold futures. We're looking now at $60 as well to the downside on Brent, which would be, if we close below that, would be the first time in several months we've had a 5 handle on Brent. And going into the open today, 27 minutes away, we are entering some decent earnings coming through. We'll talk about that list in a moment. But yeah, we are looking at declines here in the order of about a third of 1%. Again, the fix of the day will be very much in focus following the strongest one going back 12 months ago from the PBOC on Thursday.
Yeah, certainly you're seeing a lot of questions about the U.S. regional banks, sort of the credit stress, and really raising a lot of questions about private credit now. That certainly is setting some wobbles across this market at a time when you're seeing a flare-up in U.S. and China trade tensions. So certainly risk sentiment is something that we're contending here today, and people are kind of pulling back from risk this morning. So in terms of your agenda, we're watching a lot of things, right? Of course, leading up to the end of the trading week as well, and we take a look at the midpoint. That certainly is one thing to watch, as Dave mentioned there, for the past 12 months or so. Certainly, we'll see if there's any sort of support for the currency here in the face of these sort of blow up in U.S. and China trade war and the like here. So certainly that's going to be the key focus. Futures are in the red this morning. So obviously in terms of sectors to watch, it's the precious metals, the gold, the silver miners out there. Delivery certainly is going to be interesting given our interview with, of course, the Alibaba. And also when it comes to financials, watching very closely with that one here as well. In terms of energy and casinos, right? Because given what Dave mentioned about oil prices at 5-month lows, casinos as well, we had the third quarter VIP gaming revenue rising to the highest since the fourth quarter in about 6 years or so. So that certainly could be a key driver here today as well. In terms of earnings, of course, we confirmed also that some of the chip makers like Capricorn are reporting later on today as well.
Yeah, this is going to be the first, if you think about it, this is the first time we're going to get a set of results as this company really has come under the spotlight from investors. On that very note, the other big name that's coming out today is Zhang Mining, of course, on the back of a lot of these gold plays as well. So keep your eye on this as we go into the thick of Friday. Futures, as we were pointing out, though, are moving to the downside, really down to renewed concerns. Who remembers Silicon Valley Bank?
Yeah.
Remnants of that story from a few years back. Let's bring in Paul Dobson out of Singapore, our Bloomberg executive editor right now for Asian markets, to help us understand. Paul, yeah, we woke up this morning, several headlines, including, of course, where we are with Jefferies and private credit. Paul, Why is this scaring investors at this point in time, Paul?
Yeah, hi, good morning, David. Good question. I think two things. One, it's about timing, basically, more than anything else, right? Already in the last few weeks, we've seen a couple of blow-ups on quite a large scale due to bad credit, fraudulent arrangements, taking down a couple of the companies in the US, and that spurred Jamie Dimon to make those comments about, there's more cockroaches likely to be out there, i.e., if there's one or two bad credits in the market, there's probably a few more. And so lo and behold, right on the back of that, we have this piece of news that a couple of the US smaller banks made some loans that were fraudulently kind of or involved in companies that had used them for fraudulent lending on. Only small amounts, only like $50 million, not huge amounts. And yet, because of that timing, it raised that concern about what are the credit standards like in the US markets at the moment, and particularly what are they like for the smaller regional banks, given the context, as you mentioned, David, of Silicon Valley Bank and all of that went wrong a couple of years ago. And people then tend to get very jumpy about those smaller regional banks because, they're not somebody like JP Morgan that can absorb this and carry on with no worries whatsoever. And so the stocks fell across the board, and that sort of, just sparked a little bit of contagion across the broader markets. It pushed down bond yields, people looking for a little bit more safety, little bit of worries maybe showing up in credit in the short-term interest rates markets as well. Not something that shouldn't be able to be contained, but it's more that, drip feed of bad lending. And the question is, should you be worried about the lending standards, or, should you be comfortable with the fact that this isn't a credit risk per se, it's just a few bad actors?
Yeah, I mean, is it just one cockroach? As Jamie Dimon said, Paul, is one thing. And, we've had so many guests that come on the show that talk about, if you want, the alpha, if you want good returns, you go into private credit. Is that sort of narrative, you think, now being heavily questioned in this market?
No, I don't think that's really the case. Private credit, is a lot less transparent. But I think that in most of these cases, it's not a question of the credibility of the lenders. It's not a question necessarily of the overall standing of the people that are taking the loans. It's more a question of how much due diligence is being put into individual cases and how easy is it to game the system for some of these people that have been, misusing collateral or promising collateral that hasn't really been there for the lending out. So I feel like, to broad brush or read across to that as all private credit is in trouble now, I think would be a very big step and probably an erroneous calculation at this point. On the other hand, there will be more scrutiny now. I guess everybody will be looking again at their loan portfolios and just double checking on the collateral, on the people that they've been lending to. Are they sure about it? And, it's a good time to get your dirty laundry out in public if you do have to make a confession, given that there's more scrutiny of that right at this moment in time.
Paul, before we let you go, just a quick word, if you could, on commodity markets. Obviously, gold's continuing this record-breaking rally. And on the other side of the commodity spectrum is oil flirting with $60 and really down to, I think, conversations with around Donald Trump and Vladimir Putin and potentially more oil supply. How is your team looking at those two things today?
Well, gold, David, you're probably more excited about it than I am, but it's really in this kind of frenzied uptrend at the moment, on a 9-week winning run. And this week is the biggest of all of those weeks in terms of the gains. And when you boot up your Twitter feed or whatever, you'll see, it's not just the gold bugs that are tweeting about it. It's the big names out there in the market, the Ray Dalios, the Mohammed El-Arians, talking about what's going on in gold and wondering how far the run can go, and it's backed up by there's all of these pictures of people queuing to buy or to sell from Australia to Hong Kong to Vietnam. We had some nice stories about that in India. People still buying, people seeing the prices going up and thinking, heck, I better buy now rather than wait. And that's, giving this upward momentum further impetus. So gold, people maybe want it for safety, and so yesterday would be a good example of why you'd buy it. But it's not just that; it's performing in all sort of markets at the moment. So it's more sort of a self-sustaining kind of better buy now rather than later worry at the moment. So maybe that runs out of momentum at some point. Oil prices, good news if prices keep falling, basically, for the rest of the world.
Paul, thank you. Our executive editor for Asia Markets, Paul Dobson, there joining us out of Singapore. Let's talk about another stock here this morning, TSMC, right? Raising its outlook for the year and projecting mid 30% growth in annual sales. You see the stock reacting in Taipei here this morning. We're down more than 2% here right now. Let's get to our Bloomberg Intelligence senior analyst, Stephen Zhang. He joins us here in our studios. It seems like these are blow-up numbers, but the stock is selling off in some ways. What were some of the key takeaways for you?
I think, obviously, for the result itself, it's definitely a very solid set of results. We have solid revenue, a strong margin and record profitability. So it's strong, and guidance also went up. But then, to some extent, some investors may have already expecting higher growth or CapEx for this year, and then so people asking about what's going to happen in 2026. Management didn't really provide any sort of quantitative indication, except saying that the AI demand is accelerating. So the message obviously is positive, but maybe not strong enough for some investor, given that the share price has been so stellar year to date. But in general, I think the overall AI demand accelerating is definitely, we have a strong indication for that. And so for 2026, we're still expecting continued revenue strength and also the potential uplift of the CapEx.
Yeah, to your point, right, the stock has done, not just this stock, everything else around it has done tremendously well. How good could earnings really be to justify this so people don't get scared? And I understand how markets can get carried away sometimes in terms of exuberance, but as someone who looks at the fundamentals of these companies, say a CapEx figure, are there any signs that even the companies themselves might be over-exuberant over the future?
I think at the moment, while we do see the acceleration of AI investment, but you have to, those investments are really just sort of controlled or dominated by a number of big companies. It's supposed to be some investment like across a group of corporates. I think that's part of the reason why people are arguing about whether this investment or is there an overheat situation, because the margin for error is actually tiny. And then so for the moment, I think at least from TSMC's perspective, they are definitely the leader in the leading edge chips. So no matter how it goes, as long as this AI investment continue, TSMC will benefit. No matter the future is go for like GPU or ASIC, TSMC is definitely has a very strong role there.
Fantastic. There we go. Stephen Zhang there, of course, our senior analyst at Bloomberg Intelligence. Just some breaking news right now. This is another Bloomberg scoop. This concerns Ripple Labs and quite a big number in terms of this fundraise here, about $1 billion. And this is really to accumulate more of XRP, which is, of course, the digital token linked to the company itself. It looks to be, and I'm browsing through some of the takeaways here across the Bloomberg scoop is concerned. Some of the funds will be housed inside this new digital asset unit. That's according to people familiar with what is going on. There we go. XRP on your screen, 3.5% to the upside here.
Yeah, it's interesting coming at a time when crypto markets are still quite fragile here, but especially when it comes to some of these digital asset treasuries and the like here. So we'll see how this fares. But yeah, you see XRP doing quite well here this morning. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Futures are lower this morning. This is the China Show.
Good morning and welcome back. Happy Friday to you. We'll start things off in the segment with the reference rate. Another one below the 710 handle. 709.49 there against the U.S. dollar. Stronger fixings of late this week, particularly Wednesday, Thursday, and now Friday. Coming out of the PBOC, the U.S. dollar, the Bloomberg Dollar Index, is on track for the worst week in several months. Now, on this equity market rally in China moving into the potential meeting between the two presidents. Morgan Stanley came out with a note, and what they're saying is, be a little bit careful. Yeah, you can buy the dip. Yes, it might fall, I think about 12% or so based on what their forecasting is. So maybe chill a little bit and just maybe have a better understanding of how things go, particularly as we move into that meeting.
Yeah, let's bring in Eva Lee, head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. Obviously we've seen tensions with the U.S.-China flare up again here at a time when, we are witnessing a bit of a fatigue maybe in this bull market. How are you looking at things as we count down to APEC?
Well, in fact, there are two things, right? In addition to APEC, we have the fourth panel meeting next week. So even though we're not going to have a lot of detailed policy, but it will give you sort of the direction, like how much emphasis they would put onto digital economy in terms of contributions to GDP. I mean, if they sort of saying, we will set, say, low teens in terms of a target contribution from currently 10%. So I think that is a step up. Not only that they see the importance, but also it's also revealed that the policy-wise, remember back in 5 years ago, we have some turbulent times, so meaning that this will be the past, and they will be focused more on to building up, that contribution. I think these are important if I were to sort of think about it. Obviously, leading up to APEC, we will probably find out more in terms of the trade talks, when they will eventually come up with the numbers or range in terms of tariff rates. At the moment, we all know that 130%, it's not a proper, final deal. But eventually, how they will come up with that, in terms of negotiations, I think it's a lengthy process anyway. It's not an easy fix.
I think to the point you just made on the plenum, very few people have actually looked at that and framed that as a potential market-moving event. Is that why you're upgrading tech?
Partly. We actually have been seeing, remember back in Feb, early this year, the symposium hosted by Xi Jinping.
Right, yes.
That is actually a breakthrough. Obviously, the DeepSeek lead up to this symposium. And then after that, we actually have been seeing, all these companies putting the money into work, into AI capex. And then following that in the second quarter results, we see AI monetization a lot earlier than what people expect. So it's not just spending, because FT News is talking about spending. Do we see the benefits out of it?
Do we?
Two companies telling you that they actually able to use that on advertising, on search. They managed to generate more click rates. Take rates also, have gone up. They're able to charge money to the merchants because of the AI support they gave. I think all these are very important in terms of leading up, why these stocks now trading at higher valuation compared to the past.
What can you still chase in this whole China tech space then, right now, in the short term?
Well, obviously we have been seeing one e-commerce play doing very well. Another gaming play sort of lag. So we probably can, do a bit of rotation in terms of positioning. But when I sort of looking at the broader spectrum, China versus US tech, what I noted is if I were using the PEGA, like PE to growth ratio, China tech it's now 1.4, 1.5 times. US tech's 2.5. So meaning that if you're purely looking at PER, they are all at, China, it's like 17, 18 times, US 22 times. But when you sort of including the earnings growth, the China tech earnings growth, it's higher. Maybe due to base effect in terms of where they are, in terms of the AI, development. US probably a little bit more advanced compared to China. And then on top of that, the chip localization. I think this is very important. It sort of lay out or give you the reason why at the moment China seems to be having a stronger stance in the negotiation with US. So far, I mean, what we have seen in the past 2 weeks or so. The reason is they feel that gradually they probably can rely on their own domestic chip. They can gradually rely less on the chip from the US.
Okay.
they still be able to develop AI.
Since you mentioned valuations in AI, what about hardware? That's also been an AI play ecosystem, but valuations look very expensive on that front.
Yes. I mean, the leading foundries, because at the moment, if you sort of talking about the foundries is one big company, right?
Yeah.
So all no matter A share or H share, all the value or interest going into this one stock. But aside of it, we have equipment that doing, the chip processing, the manufacturing. I think they are also interesting play within the equipment space. So anyhow, this is how I would position in terms of the overall targets. The biggest foundries, you probably should position money. The leading play, and also some of the data center. I think and humanoid. Humanoid is also another topic that
That's
some
right.
of these China pretty advanced in terms of manufacturing and supporting even some of the U.S. companies as well.
Eva, we'll hold that thought. We'll have more from Eva Lee, head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office here as well. Taking a look at the pre-market in Hong Kong that's opening up here right now as we wrap up the trading week. It is Friday. We got there. Slight moderate declines here right now. Futures are still slightly in the red here this morning, and 7-11, so 12 for the currency after that strong fix here once again. Plenty more ahead. This is Bloomberg.
Welcome back. The pre-market is looking like this. We're looking at a 10 to 1%. So some weakness coming through there in the equity complex. I should also just mention we're now looking at the lowest renminbi fixing going back to literally this time last year, October 15, 2024, the strongest fixing in 12 months from the PBOC for a second straight day.
And taking a look at when it comes to stocks to watch, we're focusing on the banking sector, given some of the concerns around credit and the like when it comes to some of these regional banks in the U.S. For the most part, the regional gauge is actually falling, but the ones in China, at least the ones listed in Hong Kong, are doing fairly okay and kind of bucking the trend in some ways here as well. You take a look at how the tech space is doing. So focusing a little bit more on the food delivery side of things here. So we've heard some talk about tightening regulation when it comes to these full delivery companies there. And we are seeing a bit of downside when it comes to JD, but just marginal. And Macau casinos, we talked about third quarter VIP gaming revenue actually was quite strong. We'll take a look at it, a mixed picture across some of the casino operators here this morning.
Yeah, we're looking at VIP revenue up 3.4%. That's from the previous quarter as well. And we're looking at total revenue plus 13% to just over 62 billion. That's patakas there. So yeah, we'll have a look at this, plus the opening bell in a couple of minutes. Stay with us. This is The China Show. Good morning. Good morning. Welcome back. You're watching The China Show. 40 seconds to the opening bell. Stronger fixing again coming out of the PBOC. We're looking at weakness broadly across the region, across tech. TSMC was down the opening minutes in Taiwan following earnings there. It's also a decent earnings docket here. In Greater China, Hang Seng Index is down about a 10 to 1%. Apart from that, everything from rare earths, gold, and regional banks is a U.S. story, but we're feeling that somewhat here in the Asia-Pacific.
Yeah, if there is sort of banking credit stress in the U.S., does that have swift implications for the U.S. economy? That certainly is one key question that we're asking here today, and coming at a time when you are seeing the U.S. and China battle it out when it comes to rare earths, chips, curbs, and the like. That does not be a good kind of concoction when it comes to risk appetite here today. So as we end up wrapping up the trading week here, this is what we're looking at here on the onshore market. So we are seeing some slight declines here in the CSI 300. We're still trading around that 4,600 level here this morning. Bonds are a bit up, though. 30-year yield is down some 2 basis points this morning. We've been tracking the move in oil markets, talking about the 5-month lows that were hit when it comes to Brent, and we are seeing Shanghai crude follow in that. We're down about 2% when it comes to the futures there. Focusing a little bit more on some big cap names like CATL are doing okay, but taking on Capricorn Technologies, that is down some 1% ahead of those earnings that come out later on today as well. To the Hong Kong story, and this is how we're looking at here as we are on track for a second week of losses when it comes to Chinese equities. HS Tech seems to be on offer here today. We're focusing on the likes of Alibaba, Meituan. There was some new, rhetoric around tightening regulations of some of these food delivery companies. We have a good interview with Min Lo with some executives from the Alibaba side of things coming up here as well. But Alibaba down 1%, Meituan in similar fashion here this morning. Tencent, though, not doing a whole lot. But yeah, we're focusing on the currency, right? We said it's a second day in a row. We've actually seen quite a strong fix from the PBOC, and we're hovering around that 7-11 handle here right now, Dave.
Yeah, and I think UBS is saying that we could actually get 7.0 is within reach in the view of UBS. They now forecast USD CNY onshore to be at 6.9 by the first half of 2026. Very, very quickly, we're looking at gold stocks coming up on your screens. This debasement conversation, FX to gold, and have a look at that. Zijin Mining's out with earnings later today, and oil stocks, of course, should be moving to the downside. We're looking at Brent at about 60. There we go. And of course, we're looking at, do we have the Shanghai crude contract? Last I checked, that was also flirting with the troughs of the year so far. By the way, speaking of energy, bottom of the screens right now, down 1.5%. That's really been one of the outperformers actually this week. In fact, the next graphic's about to show you this. So everything, so it's financials number one, energy is number two this week in terms of sectors, and then the laggards, as you can see, commercial and communication services, that's effectively your 10 cents of the world, and IT is down about 7%. So this rotation back into maybe some of your dividend plays and out of some of your big winners here.
Yeah, let's bring in Eva Lee, Head of Greater China Equities at UBS Global Wealth Management, CIO, their office. Take a look. I mean, it's interesting, right? I mean, this rotation back into some of the financials. Do you see that there's a bit of style rotation now in this market?
Well, definitely after the strong move of the growth stock or internet stocks, so that we did see the flows are rotating into the value, the dividend yield, the likes of telcos, energy, utilities, banks. These are the good dividend yield stocks. Last night I look at the China banks' average dividend yield is still at 6%. Like if you compare to the 10-year government, China 10-year government, 1.8 to 1.85, decent carry, right? So to position in. And if you sort of looking at Asia, I think it's just similar. I think yesterday the M1 supply data showing that people really have, moved part of the deposit into work, which is equity positioning. So, and the first stop, apart from the tech stocks, they will still sort of position into the big banks that they believe in, insurance as well.
The dividend plays.
Yeah.
But why have insurers done well? I mean, I was looking at some of these names. As a sector, financials have done well, certainly, but insurers have also done well. Is that a play on the markets doing well as well?
I think the first dividend yield are not that high. I mean, I think 4-ish or so.
On the insurers specifically?
On insurance companies. But they have been generated a lot of this new money. So people now, no more property investment, right? So where they could put it in, directly into equity market or into insurance funds, that they give you some sort of return. So the NBV, the net business value growth, I think in the coming result, you see some good numbers coming through.
We were just talking about your view on dollar China. You said 7 is within reach. What gets us there?
I think the government stance is very clear. They want stabilization of the currency. I understand that people were saying, hey, economy was not that great. How does that man up into 7? But I guess it's at the moment when we see sort of new growth driver coming through, China want to keep a stance is the currency is stable as it is, or even could strengthen a little bit. And versus we are seeing, the versus the US dollar currency probably soften a little. So that is resulting to a relatively strengthening of renminbi.
Eva, great to have you. Eva Lee, Head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. Now, some news now. We're talking about what's been going on in trade, and Chinese Commerce Minister Wang Wentao is blaming the U.S. for a recent escalation in trade tensions. Speaking with Apple CEO Tim Cook on Thursday, Wang said the recent deterioration in relations stems from Washington's series of restrictive measures against China. Meanwhile, Wu Xingbo, an advisor to the Chinese Foreign Ministry, told us on Thursday that China wants wants to work with the U.S., but is prepared to walk away.
Every time when we sit down for negotiation, if no agreement could be achieved, we can walk away without any agreement. So that's something we can accept. We don't beg for negotiation. We don't beg for talk. We don't beg for achievements. But if you have the willing to strike a deal, we are prepared.
And China's move to unveil export controls on the rare earth supply chain is at the center of renewed tensions with the U.S. And now there are risks of a global pushback, with other countries seeking to form a response. Joining us from Washington now is Gracelin Baskaran, Critical Minerals Security Program Director at CSIS. Gracelin, it's great to have you. We're still trying to figure out why China seems to have gone from a position of hesitation when it comes to rare earths to now a bit more assertive. Why do you think that is? And do you think in some way they are overplaying their hand now?
Thanks so much. It's great to be here. China has taken an increasingly assertive stance over the better part of this year. What we really saw starting April 4th was a series of increasingly restrictive measures, first broad-based in terms of requiring export controls to the most recent restrictions last week, essentially prohibiting the use of any Chinese heavy rare earths or magnets in any foreign military use, which is a very, very strict restriction. Now, is China overplaying its hand? China's in a tight spot. China's economy is kind of facing, some of the highest levels of deflation in modern Chinese history. You have high youth unemployment. You have a struggling property sector. You have soft demand. On the back of these challenges, what China is really looking for is a more durable tariff policy. The trade war is having real economic consequences with the United States. And so going into these negotiations, China is trying to take as much leverage as they have. But the risk is that many economies around the world are now mobilizing to counter China's restrictions.
Right. Gracelin, this is David here, by the way. So I have a two-part question for you on that. So should we consider a somewhat watered-down version of these, restrictions or policies around magnet exports eventually? That's the first part of my question. Number two is this more a PR exercise for China than it is an economic question?
It's certainly a negotiating tool. If you go back and you look at the announcement from the Chinese Ministry of Commerce, it explicitly says, China is open to bilateral and multilateral conversations around these export controls in terms of, how to create resilient supply chains. So it's certainly leaving the door open for a conversation, not only with the United States, but also with other countries. Now, these restrictions, again, some of them have there's a runway before they go into effect. Some of these restrictions don't go into effect until December 1st, essentially creating what is about a month and a half or so of room for negotiations. And we could see various things come onto the table here beyond rare earths and magnets, tariffs, and semiconductors.
There is this perception that, given this more assertive stance from China, that it is disrupting global supply chains for no obvious reasons, right? And the collateral damage that we could be seeing for the rest of the world. How does China counter some of those perceptions, per se, Gracelin? And do you think that there is going to be substantial impact when it comes to global supply chains now?
It might be too late for China to reverse the damage that's been done. It is really hard to see a world where the likes of Japan, Australia, the EU, the United States, Canada pull back efforts to essentially warp speed the development of not only rare earth capabilities, but permanent magnets. Even if you were to de-escalate conflict, the trust has been broken in terms of going back to having a more harmonious relationship for crucial supply chains. And again, keep in mind, this comes on the back of 2 years of weaponizing minerals. It was about June 2023 when we started with gallium and germanium restrictions, which affected the chip sector, tungsten, antimony, rare earths, permanent magnets. So I don't know that there's an easy rolling back. It also going forward, when we look at multilateralism, which looks quite different in the Trump administration, critical minerals are one of the areas where everybody seems to want to work together. We've seen the G7 start to talk about a joint price floor to create a market outside of China. So I think that line has already been crossed in terms of where we're headed.
Gracelin, I wonder why the rare earths and the magnets component is creating such a big pushback when you look at, say, G7. You just mentioned that, right? But, I mean, the U.S. is doing the same thing, but it's for semiconductors, right? The foreign direct product rule. They're doing that for decades. It's directed at China. So what's the difference, you think?
So what's really difficult about this rule, and I'm not, absolutely, here in the U.S., we've been using this rule particularly frequently since 2020. What's difficult about this rule is, number one, it's really crippling to the defense industrial base. These restrictions are targeted at the defense sector. When you think about the math of what the supply chain looks like, it's really hard to find any alternative solution here. You're talking about China, which produces, 60% of rare earths, separates between 70 and 80% of them, and then produces about 93% of the world's permanent magnets. This rule applies to any magnet that uses just 0.1% of Chinese heavy rare earths. That's almost every magnet on Earth right now. So what this does is it essentially cripples our defense line along with many of our allies, and in an era of increasing conflict and tension, not only in the Indo-Pacific but in Eastern Europe, in the Middle East, puts us in a pretty precarious position. So while it's true they've both been used, it's the concentration of capabilities in China for the entire supply chain that makes this particularly punitive.
Gracelin, thank you so much for the time. Let's speak again soon. Gracelin Baskaran, their Critical Minerals Security Program Director at the CSIS. Right, our Bloomberg opinion columnist, David Flickling here, on this specific rare earth fixed topic, has a really good piece here saying that the U.S. needs to spend, get this, about 200 to 300 quite a big amount there of monetary value to secure supplies of rare earth minerals. Subscribers can read about that piece on that piece rather on the terminal and also on Bloomberg.com. Plenty more ahead. This is the China Show. Welcome back. You're watching the China Show. So Singles Day, that's the big Alibaba spending festival, actually kicked off in just a few days ago. Already a number of brands are passing 100 million renminbi in first-hour sales, already exceeding last year's figure. Let's bring in Min Lo, our China correspondent in Shanghai, for us to talk us through the progress we've seen and what is yet ahead. Min, you were actually at that briefing, that media briefing yesterday. What's different about this year's Singles Day strategy?
Yeah, I think the biggest difference is that Alibaba this year is launching the biggest ever deployment of AI across its e-commerce platforms and services. We're talking about AI-assisted search and recommendation algorithm for consumers, also AI-generated content for merchants that could help them lower the cost of advertising. There are a number of AI-native tools in the app, including, for example, an AI virtual fitting room, if you will, where you can get your AI avatar that is supposed to be true to size to try on some of the clothes that you're interested in trying. And you can see on the screen here, there are some significant returns on their AI deployment so far. We're talking about a 10% increase in click-through rate, 20 percentage point increase in product relevance, and a 12% increase in ROI when it comes to advertising spending. And I got a chance to speak to the vice president of Alibaba yesterday exclusively, and here's what he said about the impact of AI on customer experience. Have a listen.
We actually did a very substantial rework of our search and recommendation this year, starting with our 2 billion product listings, right? Because we have really one of the biggest product category in the world, which is 2 billion strong. And we actually used AI and large language model to rework that underlying product catalog. We enriched the product content. We also re-indexed the entire product catalog, which is a foundation for the search engine. And you can ask our search engine, what is the best gift for someone who is really stressed out in high school and he's having headaches, for example, right? And AI will be able to comprehend your semantic query and to analyze your underlying need and give you recommendations of the right products. So this was not possible in a simplistic search engine where you have to tell the search a product name and it's going to give you that particular product.
So you mentioned 20% increase in product relevance. So does that mean we can expect very robust numbers from this year's November 11 sales then?
So 20% is actually a very large number, right?
Yeah.
Because, I mean, we operate a very mature tech stack. I mean, this technology stack has been optimized year over year for many years. So you don't often see 20% lift in A/B testing, but we are able to achieve that with large language model. Of course, there are modifiers, right? That's 20% increase in relevance when the consumer's queries are semantically complex, right?
How much is the conversion rate though?
So if you have a 20% uplift in relevance, the conversion rate improvement is also quite significant. We are able to achieve a 10% improvement in our click-through by using large language model to give the consumer more positive surprises, right? The idea is that, I mean, the consumers have a lot of product browsing and click preferences, but sometimes you want to see new products, right? You want to see something that you've never expressed any interest in, right? And that was kind of hard in our original architect.
So how much is the cost savings that you're able to help your merchants achieve with AI?
Yeah, so because we are providing a very comprehensive suite of tools for our merchants, right? Including content generation, including customer service, including marketing, and all these other use cases. But I'll just give you one example. So in AI customer service, like chatbot, we provide our merchants, and the cost saving is actually 20 million Chinese yuan per day.
Your CEO did mention that Alibaba is planning to increase capex spending beyond the 380 billion yuan that was previously pledged. Yeah. Do you have a concrete number to share in terms of how much more investment in AI?
So obviously, I'm not the right person to answer that question, but I'm on the application end. What I can tell you is that the actual number of usage in terms of the AI inference and tokens is actually growing pretty fast.
So Alibaba is betting big on AI, and they appear to be stepping back a little bit from their price competition. According to our Bloomberg intelligence analyst Catherine Lim, we're seeing Alibaba's competitors like Douyin, Kuaishou, and others. They are launching the November 11 sales a few days earlier than Alibaba, trying to lock in those early orders and bundling incentives. But so far, Alibaba's average discounts is around 15%, which is on par or narrower than some of its competitors. And according to Catherine Lim, she's saying that this means that Kuaishou and JD, they might have their GMV sales exceeding Alibaba's for the second straight year. But it seems like Alibaba for now is confident that with their AI investment, they're gunning for the long-term returns, and they're willing to cede a bit of the short-term gain in the meantime.
All right, Min, thank you. Yeah, hopefully their AI can help us figure out what to buy for two sleep-deprived anchors here in Hong Kong. Great interview there. Min Lo, our China correspondent, joining us out of Shanghai. Well, if you're a subscriber and want to rewatch that interview, you can watch it through our interactive function, TV Go. Become part of the conversation. Send us instant messages as well. Check it out at TV Go. Some big corporate stories that we're tracking for you today. The consortium buying video game maker EA is set to add more than a dozen banks to its underwriting group. This comes after JP Morgan put up $20 billion of debt to bankroll the leverage buyout. Around 15 banks are likely to join the underwriting group, with some taking around 10% of the deal each, while JP Morgan will keep around 40% of the deal. Bloomberg has learned that billionaire Paul Singer Elliott Investment Management is raising billions of dollars in new cash. A source tells us the hedge fund will take in as much as $7 billion in a fresh fundraising round as it prepares for new trading opportunities. The move comes at a time some of the largest multi-strategy hedge funds remain closed to cash. Citadel Securities India COO Gustav Eriksson says the company is mulling an entry into commodity markets in India as it sees the country as a key growth driver over the next decade. The firm is scaling up its onshore business in India, which it says remains unaffected by an investigation by the nation's markets regulator into Jane Street.
If I look at where growth is going to come from in the next, call it 2-3 years in India, and what gets me excited about the market, I think one is something you touched on earlier, which is deepening cash market liquidity. Two is something like MCX and commodities. We see tremendous growth there.
All right, so, I mean, they talked about the big India story there that really takes me to gold, which we'll get to in a moment there. But yeah, some of the big decliners across the Hang Seng Tech Index were virtually every single stock, with the exception of one or two, including NIO, which we'll get to in a moment, is down. We're down about 2% on the benchmark. We've cut through the 50-day moving average. We're now down, get this, 12% from just 2 weeks ago. So we've entered a correction this week, and it looks like we're extending this rotation out of the big winners, such tech, into financials and income and some of the dividend plays. We'll talk about that in a moment. Gold and NIO coming up on your screens as well. Very, very.
Yeah, let's start with gold, right?
Yeah.
You have gold, you have silver hitting records there. Of course, the credit fears in the U.S. You have also U.S.-China trade tensions. That's really fueling that gold trade once again. So some of these miners are doing quite well, with the exception of Zhang Mining. That's down some 1% ahead of its earnings. But yeah, gold spot, we're on track for basically a 10th week of gains when it comes to the precious metal. And it's really kind of spilling to the likes of palladium, platinum as well. We're on track for some weekly gains there as well. NIO, this stock seems to be flying here today. The big story this week was, of course, this shareholder lawsuit when it came to GIC, the sovereign wealth fund in Singapore. Looks like the stock right now recoupering some gains. We are up close to 3%.
Yeah, there we go. On the other side of this break, we'll talk more about the big market themes of the day as we go into the weekend, the weak dollar story, the weakness across equity markets, not just in Greater China. Coming up next, we'll talk more about big tech.
Welcome back to the China Show. Here's a look at the HSI half hour into the session here. So we were talking about, the U.S. regional banks and some of the wobbles there, and really at a time when trade tensions are kind of ramping up between U.S. and China. That doesn't really do well when it comes to risk taking. And so there you go. You are seeing the HSI now around those session lows. We're down about 1% for the gauge, as well as with 8 shares here this morning. I think interestingly enough, we talked about that Morgan Stanley note, saying that maybe now is not the time to really kind of be piling on risk right now. And if tensions continue on past November, look overweight A shares, they say.
Yeah, well, that's also where you really have I think for one, you're seeing a rotation into some of the big banks, and that's where you get the dividend plays. That's also where you have the national team in terms of providing a more solid floor as far as equity markets go. And just speaking of really what we've seen, right? So what we showed you there was the Hang Seng and the Hang Seng China, which I think if you're more on the bullish side, that's really where you should be looking, because the Hang Seng Tech is going to make you depressed today when you look at where that's trading. We're down about 2%, 12% now. This rotation out of IT and some of the communication services, that's the likes of Tencent, for example. And that's just this week alone. And it's gone into the big financials, the big banks. Insurers have done very, very well this week. So this rotation, right, within sectors, within factors are going into some of the laggards from the big winners this week. The macro picture is this. So you had another very strong fixing coming through out of the PBOC. The Bloomberg Dollar Index is on track for the worst week since July, and we've now fully priced a rate cut at the end of the month here as far as the Fed goes, with the 2-year yield now effectively trading at a 3-year low. The other big story, of course, in case in the smallest chance that you've missed it, is really gold, silver, precious metals, and we're now trading at about, it's crazy, right? We're a good day away from 4,400 in gold.
Yeah, we have a great piece from Shuli Ren, our Bloomberg opinion columnist. She says it's semi-rational what we're seeing in the gold run here right now. We have her coming up at this hour as well to talk that through. For more on markets, though, let's bring in our Bloomberg MLI strategist, Mark Cranfield. He joins us from Tokyo here this morning. Mark, we were talking about, it seems what we're seeing in these kind of U.S. regional banks is reminiscent of what we saw back in 2023 with SVB, coming at a time when you are seeing this flare-up in tensions between the U.S. and China. Do you think this is more about a hit to risk sentiment, or do we really have to start thinking about looking really close into these balance sheets of these regional banks now?
I think the scary expression is mark to myth. Bloomberg have a very good story about this academic report which has been looking into the private equity space. Now that is closely linked to what's going on in the regional banking space as well, because people have been concerned for some time that the build-up in private equity assets has really been very quick. It's probably gone too far. Trillions of dollars of money being sucked in there, even extending it to individual investors as well. It used to be something that only institutions played in, but this year especially, the net has been widened to individuals as well. So that means that asset quality almost certainly has been deteriorating for a while. And when traders see this expression mark to myth, the more seasoned people will be thinking back to 2008, because that's exactly what was being talked about when the subprime crisis came to a head, because the valuations were being a bit mythical in some of the subprime sectors. There was a lot of leverage. People were doing some of their own valuations even in the banking and hedge fund space, which are a little bit questionable. If we're anything like that again, people will be very nervous, because we can all remember how quickly things unraveled back in 2008. It's certainly early days, but when you get an academic warning that already there are signals that we should be worried about, people are definitely going to take a step back, and they're going to start thinking about, should we be defensive, particularly as we're into the fourth quarter now. It's been a great year across many asset classes. Wouldn't you want to book some of that profit before you go in for year end?
Well, Mark, speaking of, I'm glad you ended on that, because we are maybe seeing that today or this week in Chinese tech. We're down 12% now from just 2 weeks ago. What do you think is going on there?
Well, I think a lot of that is to do with the fact that whether President Xi and President Trump actually meet is still an on-off decision. Whether anything worthwhile comes out of it if they do meet. And then you've got the fact that there's really a lot of uncertainty in terms of the valuation sector. Although we've seen TSMC, we've seen ASML give good projections for 2026, there's a very high bar to satisfy people. We've still got to get through Tencent and Alibaba earnings as well, coming up in the next couple of weeks. And people will really want to be given very aggressive numbers, a very aggressive outlook, to be satisfied with what they're seeing so far. So it's no wonder that people are taking a slightly defensive approach here. There's a lot of goodwill priced into markets now. And then you hear the story today Bloomberg have about Hong Kong is expecting up to 200 IPOs. Can you imagine the amount of money that's going to be drained out of the market if they really have a pipeline of IPOs like that? No market, no matter how good it is, can sustain that number of IPOs. And a lot of them will want to try and squeeze them in before year end as well. There's going to be a lot of money being taken out of the market, and that will affect tech sector, it will affect all sectors in the weeks ahead.
Mark, just a quick note, if you could, on gold. I mean, there's almost a competition going on right now. Name your technical indicator, or name a reason not to get into gold, but no one seems to be listening to any of these things.
Who knows whether today is the turning point for gold or not? But I would just point out that today spot gold started about 33% above its 200-day moving average. A lot of long-term investors look at the relationship between where a current price is and where the average is. 5-10% is a normal kind of range. 33% is extraordinary. That means that if we do get a turnaround in gold, the dip buyers could be a long way off. We could be down several $100s before we find any serious dip buying.
Mark, thank you. Mark Cranfield there in Tokyo for us, our MLive strategist. A reminder, really, of this gold rally. Okay, just some news to tell you about while we were just having the conversation. BYD should be session lows coming up on your screens. This about 116,000 cars being recalled here. So the Chinese regulator says, that's according to the Chinese regulator, because of some safety concerns, we're down about 1.6%. I'm still looking for more reasons. Yvonne, do you see anything on
the
BYD
only thing that we're seeing in
them?
terms of what safety concerns is that there's a component design issue. So that's the motivation behind this recall. So that's all really what we know so far. But yeah, we are seeing the stock react a little bit more negatively on the back of this news here this morning. So that certainly is one thing to watch moving forward. We do have that interview, of course, with Stella Lee. We'll replay. That, of course, was before this news. But take a look when it comes to, let's continue the story, right? When it comes to regional bank stress in the U.S. and the back-to-back reveal of loan fraud by some of these lenders, right? Zions Bancorp, Western Alliance Bancorp is really renewing concerns on Wall Street over the health of the financial sector. For more, let's get to our Bloomberg Intelligence's Matt Ingram. He joins us live from Sydney here. Matt, of course, you've been tracking what's been going on overnight. I mean, how do you think is the system placed when it comes to this upsurge in bad credit now?
Yeah, g'day, David, Yvonne. Look, the world's in a very different, healthier place than it was in 2008. The Fed and other central banks really forced banks to beef up their balance sheets to really beef up their liquidity. And so smaller banks are one thing, but when we think about the system is incredibly healthy. Capital and liquidity ratios are as healthy as they've ever been. So those big banks, the JP Morgans, Bank Americas, etc., can withstand a pretty big hit before we'd be concerned. So I think on that front, things look okay.
Maybe related to this is a reminder of private credit. Of course, a lot of people have gotten into that. There are questions around maybe some credit standards. Are we seeing bad things in private credit simply because we're looking, or is there something to really worry about when it comes to private credit?
That's the trillion-dollar question, David. Credit spreads are incredibly narrow. Junk bonds are trading at almost record low spreads, so that suggests that the risk tolerance of the market is sky high. Should we be worried about private credit? Well, we're starting to see some of those bigger collapses. Jamie Dimon obviously talked the other day about a hit that they'd taken. So, as I said to you off air, I think caution is definitely the name of the game. But should we be worried? Well, not yet.
In terms of in Asia, then, what do you think? Where are we seeing that sort of big private credit exposure now in the region?
Yeah, look, we've written a lot about Macquarie's exposure in their asset management business. They've grown that now to $26 billion, which is a decent chunk of their balance sheet. They're not on the hook for all of that, but certainly fast growth from Macquarie is something we're watching. And as we see these collapses of these big private credits coming through, we're not seeing that flow through Macquarie's portfolio, but certainly from our coverage, that's where we're watching. Very big book of private credit. You'll note earlier in the year, Macquarie sold their listed asset businesses to focus more on this private type assets. So I think watch this space. That could be something to keep an eye on.
Matt, thank you. Matt Ingram there, Bloomberg Intelligence senior industry analyst, joining us out of Sydney. Now, despite fears of a bubble, Wedbush's Dan Ives remains bullish when it comes to AI. He joins us on next on where the next wave of tech growth could come from, whether any pullback is a buying opportunity. All right, checking when it comes to TSMC, that stock continues to fall here this morning. We're down some 2%, now, despite these pretty blowout numbers that we got in the earnings yesterday, right, when it came to guidance and the like, and really talking about this AI mega trend. So, is it, the expectations were a little too high? Was it all in the price already? That certainly is a key question here as well. And yeah, maybe, despite the fact that, the AI demand story still seems to be quite strong, I think investors might already be ahead of it.
Yeah, they've taken some of the bars maybe slightly too high. I mean, just looking at just the one-day reaction, right? So obviously, when you look at the price targets for the stock itself, still substantially higher than the current levels. The other interesting bit, of course, this week was the U.S. ADR premium over the Taiwan listing actually hit a 20-plus year high, but that's down to really market mechanics, apart from other things, of course. But yeah, the CapEx figure there was really the one that came in quite optimistically. Okay, I'm going to invent
optimistically. Yeah. Joining us here is always an optimistic Dan Ives when it comes to tech, global head of technology research at Wedbush Securities. It's great to have you back here in the region.
Always great to be here.
What can I glean from these TSMC results, and how is it going to tell us about the earnings for the rest of the tech space?
It's 10:30 p.m. in this AI party. It started 9 p.m. and that party goes to 4 a.m. And the reality is, look, this is going to be a 2 to 3 year left in this bull cycle for tech. Look, haters are going to hate. Bears will say it's this is a bubble. I could just tell you, this is a fourth industrial revolution. We are just in the early days of this playing out. I think those numbers, and what we're going to see throughout tech earnings, it's going to be validation for the AI revolution. And I think the bears, look, when the bears are in hibernation mode, they can't see AI in the spreadsheets.
Are you looking specifically for anything in the guidance of the upcoming earnings?
Look, I think demand and supply for NVIDIA chips are 10 to 1. So just start there.
Okay.
Then you think about AMD, now that they're, obviously...
And all these deals.
They're going to be in all these deals. Intel gets brought in, TSMC. And then you kind of, if in a puzzle, look at the hyperscalers. I think right now Microsoft Google, Amazon tracking anywhere from 5 to 7% above expectations. Look at Oracle, what they're seeing. Look, you put the pieces together here in the puzzle, especially names like Palantir and others.
Yeah.
It shows this is the next phase of the AI revolution. And that's why I think we're going to be talking about 25,000 NASDAQ, 27, 30,000 as this all plays out in this AI supercycle.
I have to be a hater, I guess, because of how bullish you are. I'm not really a hater, but I'm just going to play the hater.
Just to play the devil's advocate.
You mentioned about these deals, these circular deals. When you're talking about $1 trillion that OpenAI is willing to kind of pay for, I mean, we don't even know how they're going to get the money for it, but what does that tell you about, where we are? I mean, people say that is a bubble.
Sure. So look, and I get that. As someone like myself covered tech stock back in the 90s, right? So people make comparisons. See, I view it apples and oranges because here you're building out the next economy for enterprise, for consumers. And we're talking about like autonomous, robotics, like the future.
So it's not like vendor financing that we
exactly.
saw.
So, and I view it as like if I'm Sam and OpenAI, if I'm going to give Lisa, Sue, and AMD $1, but I'm going to get back $15 to $20, that sounds like a good deal. And I think that's essentially how this is playing out. Look, I view it as more collaboration in terms of big tech in this build out. But that's where we are. I just don't. Look, we're going to continue to have these moments where investors be like, that's it. Oh, that's a sign of a bubble. I just think right now, Street's underestimating numbers, anywhere from 20 to 30% over the next year, underestimating the super cycle for AI, and I think underestimating the second, third, fourth derivative winners across tech.
Do we go a step further beyond simply vendor financing or collabs? Let's call it collabs. Do we get more mergers? Does it make sense to vertically integrate some parts of this?
Yeah, I mean, look, think about like, where are the chokeholds? Power. So you're going to see more and more acquisitions, whether it's on nuclear and fusion, I believe, from big tech players.
Right.
You think about acquisitions on the use case side, because right now, Massive AI, Palantir is really front and center, but you got names like MongoDB, Snowflake, and many other in software where, look, software back against the wall right now, right? And you saw that even like with Salesforce and others. So I think we're going to see more and more M&A, both from software and big tech players. Look, and what that means, that's bullishness, in terms of where I think these tech stocks, going forward, just given the trends, a deregulatory environment, a Fed that's cutting. I get the U.S.-China tensions, and that's something that obviously everyone's navigating. But I think you continue to this is a game of high-stakes poker. And I think if you've been able to navigate it, that's how you've been able to make a lot of money since April.
But if China is trying to enforce at least this whole, these export curbs around rare earths, for example, doesn't that have some sort of impact on global supply
I view it
chains?
as it's all negotiation, right?
Okay.
This is all a game of poker, and they're on the same side with U.S. and Nvidia. But at the end of the day, China, there's a super cycle going on. U.S. super cycle. So I don't view it negatively, maybe like some others, because I view it competition. Guess what? That's bullish. I mean, our Ives AI 30, we have Alibaba and Baidu, because I think that's bullish for China. Just like what's happened in the U.S. So I view this much more of a global super cycle. It's actually being led by U.S. and China rather than some sort of, battle, and that's going to be negative for the names.
What about just short-term investment strategy, right? So Palantir, good company, arguably very bad stock. It's trading at, I don't know, but it's some crazy multiple. How do you approach something like that? Who's bullish, but you look at a company, it should not be trading at that multiple.
It's like a Palantir, right? They hated it at 12, despise it at 50, yelling from the mountaintops at 100.
Okay.
So the point is, they've missed, obviously this 15-bagger. I believe Palantir is $1 trillion company in the next 2 or 3 years. Because my view is that if you just focus on 1 year PE valuation, you missed every transformational growth stock. You missed every transformational growth stock the last 20 years. So you have to be able to look out. But look, I get it in terms of in the spreadsheets, they can't see these things. But for someone like myself, travels the globe, a name like Palantir, I view that as really one of the leaders of this AI revolution.
How you've been traveling around the region. Obviously, we've been talking a lot about the China tech and AI sort of race and the like. How do you see the parallels or differences between the U.S.?
Yeah, I think here. Look, if I just compare over the years, right? A lot of skepticism. Maybe 4 years ago, 3 years ago, and now, no matter where you go in the regions, who are the winners, whether it's on memory,
Yeah.
infrastructure, energy. Because the reality is it's a deregulatory environment, and you can't fight the trend. Trillions being spent, okay, you could argue valuation on some of these names, and that's all in the eye of the beholder, but it's like, okay, what are the second, third, fourth derivative beneficiaries? And I think it's very positive in terms of just the overall sentiment. Look, you're going to have some white knuckle moments. You guys always talk, and I get that, but that's all part of this journey where I believe tech stocks go higher, both in U.S. as well as in China.
When you look across the AI ecosystem that they're creating in China, for example, everything from the foundries all the way to the designers, all the way to the end users, where do you suspect the gaps are going to be? In other words, where do you see the opportunities as you draw the parallels with what we're seeing outside of China?
Look, China is clearly ahead on power. Right, okay. And that's going to be a chokehold in the U.S., and that's why nuclear, and that it definitely...
Is it nuclear, by the way?
I believe it's going to be, for U.S., I think it's nuclear. I think nuclear, that's why ACO is the name that we've been super bullish on. Look, when you look in China, like robotics, like massive innovation that's happening. You look at ultimately what's going to happen with Huawei. I believe Alibaba, to me, is just a massively dislocated name. That's why we're super bullish on it. Baidu is another one. And I think what you're now seeing is just this massive innovation wave coming to China. It's not just about big tech in China. It's about whether it's on mobile, whether it's on auto. So this is going to be a time right now where I think globally investors want to risk on when it comes to the China market.
Yeah.
I get this U.S.-China battle, and we've been navigating it, but you cannot let it deter you from a fourth industrial revolution that we're living in. Because it comes down to, if you watch the party from the outside through the windows, at 6 a.m., the Bulls and the Bears meet up at the diner. Bulls had a lot better night than the Bears. So the point is that speaks to my view in terms of where we are.
You don't want to get in front of that train. Yeah. When you talk about the likes of Alibaba, likes of Baidu, is it better in terms of in China to focus on these big beta names, or do you look at things like a CamperCon now as a U.S. investor?
I think for me right now, it's about China big tech. I still think it's way oversold. I mean, obviously you've had some rebound, but investors are not appreciating what this can do for Alibaba, for Baidu, for JD, in terms of where I see it.
Sure.
And I think also, like, these are companies that are transforming. Maybe an auto company today might be a mobility company, over the next year or two. So to me, it's big tech in China that continues to be the core play from a U.S. perspective. Yeah. And then ultimately you look at the derivatives as this plays out on the memory side and others.
You're here in the Asia Pacific several times a year. Do you notice a big difference between your trips? What's the sort of the delta on what you observe on the ground?
I'd say delta, let's say a few months ago, was a little more like a lot of nervousness.
Okay.
Now it's like, who do I invest in? What am I missing? Where do I go? So I think it's much more of that attitude across the world that I see, because, look, I think investors are realizing, like, you can't fight these numbers. When you have big tech spending $350 billion and probably going to spend $450 billion CapEx next year, sovereigns around the world now starting to get in, Middle East, obviously UK and others, the biggest beneficiaries there, it's U.S. tech, it's China tech. How do you capitalize on that?
Dan, fantastic to see you.
Great to be here
in the
as
region.
always. Thank
Let's
you.
do this again. Dan Ives, of course, Global Head of Tech Research at Wedbush Securities. Plenty more ahead here on the show. We will leave you just with a look at cash markets as we go into the weekend. A little bit of weakness coming through. Kospi, though, is continuing its record run, albeit, of course, fairly modestly today. Plenty more ahead. This is the China Show.
Some big stories that we're tracking for you today. India's foreign ministry says it's unaware of any conversation between President Trump and Prime Minister Narendra Modi hours after Trump said Modi pledged to halt Russian oil purchases. Now, a spokesman says consumer interests remain India's top priority in energy imports. Trump imposed 50% tariffs on Indian goods over its Russian crude purchases. The White House is poised to deliver a major win for automakers, easing tariffs after months of lobbying by Ford and GM. The conversation Commerce Department is expected to announce a 5-year extension of an arrangement that allows car makers to reduce duties on imported parts, a key offset to Trump's record-level auto tariffs. The announcement could come as early as Friday.
Speaking of autos, one stock we've been focused on in the last 30 minutes is BYD. And right now we're trading at about session lows. Not a lot, but it's quite a news flow coming through in this recall here. We're looking at safety concerns. Not a lot of detail just yet out of regulators. But obviously this is just the latest in what's really been a challenging, I guess, optics environment for the stock itself. And as you know, we've been stuck within this 100, 110 range for some time now. Plenty more ahead here on the China Show.
$11:29 a.m. in Tokyo. Japanese markets are going to that lunch break here right now. We are still seeing a down arrow story when it comes to stocks there. We're down about 0.9% on the Nikkei 225. We just got some lines crossing the last few minutes, and local media has been reporting about what the opposition party leader is now saying in terms of a coalition chance with the LDP. They're putting those odds now at 50-50. This is according to Hirofumu Yoshimura, the co-leader of Ishin here. So if that's the case, if they can actually push this forward, there is still a chance that the LDP leader, Sanai Takaichi, can become Japan's first female prime minister. But again, it's down to a coin toss here right now, according to Ishin as well. In terms of what we're tracking, obviously there is still a date that's set in place where the LDP and CDP have now agreed to nominate the new prime minister on the 21st. That's a date that we are now circling around for that, Dave.
Yeah, well, separately, right? We're trying to figure out, because this Takaichi trade actually took shape about a week and a half ago, and we'll see how really strong that is in terms of sector groups and the BOJ. The other thing we want to talk about, well, let's stay here on theme here. So you have, we talked about some sector plays, right? So you have nuclear, and then you have defense, poised to gain from any coalition led by the LDP. That's of course the big assumption and if there. Alice French joins us right now to talk us through the taking stock piece of the day. Alice, good morning from Hong Kong. Thanks for joining us. So, how have these sector plays evolved around what now seems to be still a very fluid situation in Japan?
Morning. Yeah, absolutely. I mean, it's all about the Takaichi trade, as you mentioned, and whether or not we're going to see a revival in that. We saw a bit of a lull this week when there was a moment there where it looked like we could have an opposition prime minister. And of course, that's still not entirely out of the question, but it does now look more likely that Takaichi will be able to figure out some kind of coalition to take that top spot. And of course, that means this Takaichi trade, which is essentially buy into stocks, sell JGBs, sell the yen, and within stocks in particular, anything that would benefit from her kind of pro-stimulus approach. So as you mentioned, defense is big. She wants to restart some of the nuclear reactors, so anything kind of nuclear or energy related, infrastructure, tech, construction, all of those things really kind of, grew last week after we found out that she was the new head of the LDP. And so, investors expecting more gains in those areas if she is able to secure that prime ministerial position. But of course, I think they need a bit more clarity around whether she can actually do that before sort of piling all in back again.
Yeah, certainly. As they say, it's a 50-50 bet here right now. How are people looking at this whole Takaichi trade now? What are analysts saying? What does it mean for equities moving forward?
Yeah, I mean, it's interesting, actually, if you speak to strategists and fund managers too. I mean, to be honest, whether we end up with an opposition-led government or a Takaichi-led government, both of them are probably going to be, pretty pro-stimulus. Both of them want more government spending and sort of fiscal expansion, which, of course, is good news for equities. Interestingly, on the Ishin side of things, as you mentioned at the top, we have this now quite decent possibility that we could have an LDP-Ishin coalition. Now, Ishin is Osaka-based, okay, that city that is pretty popular with tourists too. So there's expectation that if Ishin were to join the ruling coalition, there'd be more investment into Osaka. They would push for that kind of, those kind of policies in the government. And so we saw yesterday, actually, companies that operate in the Osaka area, so things like local railways, really rallying yesterday on expectations of extra spending. So that's another area of the market that I guess, people might have expectations for. Of course, banks remain a big issue, right? We know that Takaichi is is slightly more easy when it comes to her monetary policy stance, and there is a bit of speculation that she might put, some pressure on the BOJ. It might be harder to raise those rates going forward, and we had seen banks really suffer from that last week. Of course, we know BOJ decision coming up in the next couple of weeks. I think that will, as we move past the PM vote expecting next week, that will be a really big area of focus, and the bank sector will be kind of a bellwether, I think, for how people are feeling.
All right, so is it worth trying to predict what the BOJ is going to do in 2 weeks' time, or do we need to wait for the vote and then we can talk about it?
It's tough, I think. If you look at, overnight swaps right now, it looks like we're looking at a maybe kind of 15 to 20% chance of that hike, which is a lot lower than people were expecting before Takaichi was elected, right? So, I do think a lot will rest on what happens next week. But we know that Ueda yesterday, he's leaving the door open for a near-term hike, and so it's definitely not out of the question. But with all of this political uncertainty, not just in Japan, but of course globally, and sort of jitters around that fiscal spending, I think, it's still up in the air, and people will be looking for any even slight mention of kind of a change in approach from the BOJ or from the government. And so, I think the next week is going to be really pivotal in terms of that monetary policy outlook.
All right, well, you're going to be busy. Alice, thank you so much. Alice French in Tokyo for us. Here are some of the other stories we're tracking right now. So we'll start things off here with UBS. It's tightening its scrutiny of client money sources in its wealth hubs here across the Asia-Pacific. That's pushing some customers for greater disclosures to reduce the risk of further clashes when it comes to conversations with regulators. Now, the Zurich Bank lender has, we know, of course, it is based there, has enlisted Deloitte and KPMG to review client documentation, primarily in Singapore, but also in Hong Kong for any illicit activity. Now, global banks are ramping up hiring in Taiwan's booming $8 trillion wealth market as the island opens a new private banking zone in Kaohsiung. UBS, HSBC, BNP are some of the ones that are expanding their teams to tap a surge in homegrown affluence fueled by this massive AI boom in semiconductor demand. Now, Taiwan has more millionaires than Hong Kong and nearly twice as many as Singapore, making it Asia's next big wealth prize.
Now, Alibaba is carrying out the large-scale deployment of its generative AI across its e-commerce platforms for the first time during this year's Double 11 shopping festival. Speaking exclusively to Bloomberg, Group Vice President Kaifu Zhang also told us how the technology is helping partner merchants and enhancing the overall user experience.
We actually did a very substantial rework of our search and recommendation this year, starting with our 2 billion product listings, right? Because we have really one of the biggest product category in the world, which is 2 billion strong. And we actually used AI and large language model to rework that underlying product catalog. We enriched the product content when it also re-indexed the entire product catalog, which is a foundation for the search engine. And you can ask our search engine, what is the best gift for someone who is really stressed out in high school and he's having headaches, for example, right? And AI will be able to comprehend your semantic query and to analyze your underlying need and give you a recommendation of the right products. So this was not possible in a simplistic search engine where you have to tell the search a product name and it's going to give you that particular product.
So you mentioned 20% increase in product relevance. So does that mean we can expect very robust numbers from this year's November 11 sales then?
So 20% is actually a very large number, right? Yeah. Because, we operate a very mature tech stack. This technology stack has been optimized year over year for many years. So you don't often see 20% lift in A/B testing, but we are able to achieve that with large language model. Of course, there are modifiers, right? That's 20% increase in relevance when the consumer's queries are semantically complex, right?
How much is the conversion rate, though?
So if you have a 20% uplift in relevance, the conversion rate improvement is also quite significant. We are able to achieve a 10% improvement in our click-through by using large language model to give the consumer more positive surprises, right? The idea is that the consumers have a lot of product browsing and click preferences, but sometimes you want to see new products, right? You want to see something that you've never expressed any interest in, right? And that was kind of hard in our original architect.
So how much is the cost savings that you're able to help your merchants achieve with AI?
Yeah, so because we are providing a very comprehensive suite of tools for our merchants, right, including content generation, including customer service, including marketing, and all these other use cases. But I'll just give you one example. So in AI customer service, like chatbot, we provide our merchants, and the cost saving is actually 20 million Chinese yuan per day.
Your CEO did mention that Alibaba is planning to increase capex spending beyond the 380 billion yuan that was previously pledged.
Yeah.
Do you have a concrete number to share in terms of how much more investment in AI?
So obviously, I'm not the right person to answer that question, but I'm on the application end. What I can tell you is that the actual number of usage in terms of the AI inference and tokens is actually growing pretty fast. And for the merchant side, I would say that we see a lot of potential for cost reduction and efficiency improvement for our merchants. It's kind of hard to give a specific number, but I would say that we're seeing exponential growth in token consumption on the merchant side. So they are using more and more AI tools in their day-to-day operation. And if you extrapolate that for 3 years, I would say that a lot of the merchants will become very, AI focused in their day-to-day operation. And yeah.
When it comes to e-commerce, we know the Chinese government has summoned some companies to end that involution campaign.
Yeah.
What specific steps is Alibaba taking in order to end this race to the bottom when it comes to prices?
The involution, the anti-involution campaign, right? So basically, so if you look at the idea of anti-involution, the idea is that we want to encourage product innovation, right? So we want to deliver higher value to the consumers instead of just competing on price. And I would say that, if you look at all the AI applications we're currently working on, all of them are focused on delivering better value to the consumers, right? So it's not about really price competition, but it's really about product innovation, right?
When do you see prices reflating in a healthy manner, realistically?
So that is a complicated question, because when we look at our data, the prices in different categories, right, among different consumer groups, they are all different, right? There are a lot of product innovations everywhere, and oftentimes product innovation will lead to higher prices. So it's kind of hard to put an overarching statement on where do we see the prices are heading. But definitely, I see the dynamism, right, is actually very strong.
Yeah, that was Min Min's conversation with the Alibaba Vice President Kaifu Zhang, just very, very recently, of course. Right, for our Bloomberg subscribers and Bloomberg clients, you can check out that interview on TV Go. That's an interactive TV function. And yeah, become part of the conversations. Plenty more ahead here on The China Show. Right, welcome back. A glance at the precious metal space and an update so silver's actually going the opposite way of gold. They have been fairly hand in hand, and correlation's been quite strong between the two. We're slightly coming off the highs of the session on spot, specifically. The reason I bring that up, and we're still up, by the way. Anybody's looking for a sign of a trigger here. Could not, might not happen today, but certainly when you look at price strength and the strength behind the move, it's certainly one of those times already after 9 weeks of gains where people are starting to feel the itch to sell, but maybe not today.
Yeah, there's certainly plenty of drivers of why we continue to see people like the Bank of Americas of the world that are pricing in and thinking that 5,000 is very much in sights when it comes to gold prices here. And this rally is really tied in part to eroding confidence in the U.S. dollar as well. Here's a closer look at what is driving its rise and what it means for the global financial system.
Metal is having a moment. Not this kind, though, sadly.
Gold hits another record.
Spot gold prices have climbed above $4,000 an ounce for the first time.
The key word is scared.
During times of economic and political and financial turbulence, you buy the dollar, you buy US Treasuries, you seek safety.
Not so much now. Now you buy gold.
What we're seeing at the moment is not like anything really that we've seen over the last couple of decades.
In October, gold extended its already furious run from last year and showed few signs of abating. Excitement is evident online, on shopping streets, and in capital markets.
Just gold, gold, gold the whole time.
This gold rally really looks unstoppable at this time.
With any rally, it naturally makes people worried. Is this a bubble? Is this going to pop soon?
I think it is a warning sign that people are very anxious.
Gold is the ultimate safe haven asset, a heart rate monitor, if you will, the health of the global financial system.
And because of that, when you see a spike in the gold price, your first question should really be what's gone wrong.
Okay, yeah, there we go. Fantastic piece again from our team at Bloomberg Originals. You can watch more of that documentary on .com and also on a YouTube channel, Bloomberg Originals YouTube channel. Really on, gold and the continuing superlatives we're talking about here.
Yeah, is it an inflation hedge? Is it something that central banks are buying?
Right.
Is it?
It's a chameleon. It could be anything.
Geopolitical tensions. It could be any sort of way
9
you
weeks
look
of
at
gains.
it. We are approaching the 9 weeks of gains there when it comes to gold. And I think truly, Ren had a really interesting piece about the sort of semi-rational run. Right? I think they mentioned that even J.P. Morgan's Jamie Dimon talking about gold and how attractive it is now was some sort of inflection point as well. It continues to be that sort of up arrow story. It's hard to kind of put any reason why this gold rally can actually go too far. But the technicals, as you say, look outrageous, right?
Yeah, and not that has stopped the rally. It's just really an observation at this point in time, right? I think Mark Cranfield has a very good post on MLive today for our Bloomberg clients. Is when you look at the starting point for spot gold today, it was already trading at a 30% premium to the 200-day moving average, which to him is pretty much insane. And then it still rallied beyond that point in time. But I guess to some extent, technicals, this can remain overbought for several more months. And I think we had a guest earlier on this week and said one of the early red flags she would look at when it comes to gold is when the correlation between gold and stocks starts to come together, because gold's supposed to be the hedge. Once it starts behaving like other things, like most other things, like stocks, that's one of the early signs you think that we might start to see a pivot back down in gold prices.
Interesting.
Yeah.
But it still brings the whole thing about debasement, right?
Yeah.
Whether, the likes of crypto and gold have basically replaced assets like bonds and FX here right
Absolutely.
now. And that continues to be a big debate around that as well. I think with that Bank of America call, 5,000, right, what could drive that is purely investment demand, they say. And if investors increase their purchase by just 14%, gold is going to hit 5,000, they say.
And that's the low end of the projections, right? And I think when Goldman joined us similarly a few weeks ago, they said 4,800, but there's when we asked what the risk was, the risk was to the upside, because we might just get more flows coming through out of the private sector. I think yesterday ANZ actually came out and updated their forecast to only 4,600, which is bizarre when you think about when I say only 4,600. But it just goes to show people are really catching up to this gold trade here as well. Okay, just to also mention the Bitcoin chart that we just showed you there, and that ratio has really just underscores how behaviorally these two assets have just gone completely diverse from each other. And now people talk about is Bitcoin, was Bitcoin the new gold? Looking at how prices are behaving, the answer is no. Bitcoin is certainly treated as a risk asset.
What we saw with crypto on last Friday up until now, I think people are still kind of licking their wounds and kind of looking at what really is the damage being brought there when it comes to Bitcoin and the liquidations that we saw there. So that divergence has been quite clear in the past week or so. That certainly is a big thing to watch here. But obviously we're still continuing to watch Bitcoin. We're still at 108,000 levels here. They're seeing a really good when it comes to XRP here. We had some Ripple lines earlier breaking there that maybe is fueling that crypto here this morning. So that certainly is seeing a bit of recovery after what has been a really volatile 7 days when it comes to crypto markets as well. But next week is quite telling, right? We have GDP data coming out of China.
A lot of data.
A lot of data coming through here. So certainly we are going to be seeing a lot of moves there, maybe potentially. We'll see. Yeah, that's the week before it gets extremely busy on the geopolitical front and the central bank front. There's a 3-day window where you have everything from APEC, and you have the Fed, BOJ, ECB, Bank of Canada, and everything in between. There we go. So it's going to be busy. So we're going to load up on our sleep
and get ready for that. My correction, by the way, this was my mistake. Miscounted it. So we are now only on 9 weeks of gains as far as gold is concerned. We get to 10 weeks next week. The record, by the way, in case you're curious, is, I believe, 11 weeks back in the early 1970s. Plenty more ahead. This is Bloomberg. Right, welcome back. Just an update on BYD and, of course, the announcement coming through from regulators earlier on. I think it's about 16,000 as far as this calling back of some vehicles are concerned. So we're now, in fact, pushing below 2% on the stock price, session lows as we speak on BYD.
And Chinese automakers are making a bigger push to tap into overseas markets, as we've talked about. And Africa is in its sights here in terms of the growing EV market there. Stella Lee, the executive vice president at BYD, says the company is gearing up to roll out up to 300 fast charging stations across South Africa by the end of 2026. She told Bloomberg's Jennifer Zazaja how this major move fits into BYD's broader expansion plans.
If we don't invest on flash charger, then this will be challenged. Right. Because here, we still is a big country here, and then still EV range and the infrastructure are the two big concerns. So that's the reason the big news for us in here is we're going to officially announce to invest flash charging infrastructure here in South Africa. How much? We're going to put maybe 200 to 300 before end of next year.
How much are you willing to put in, though, for that?
This is big money because each flash charging costs a lot of money. So this is a big investment as our step one.
Let's talk about other expansion plans. You haven't been in the U.S. at this point. Are you talking to the Trump administration at all, potentially, about moving there?
Well, we didn't have plan to into the U.S. market.
What about Europe? Let's talk about your play there. How do you mitigate some of the risks that the regulators are maybe putting on your company to expand?
I think we're doing very well in Europe, and also our facility in Hungary will start operation by end of this year. Then in Q1 next year, we will start to do ramp up to produce our car over there. So BYD already in the position turning ourselves to be local producer over there. So then BYD is doing very well, and then on dealer networking, on after sales service, and the people just enjoy our car.
There's some reports that potentially Spain could be the next hub in Europe. Can you give any validity to those reports?
I don't really follow that. My big more follow is really satisfy our consumer, our customers needs, and then for a lot of politics, a lot of topic is for us is a short-term play, but the BY is a long-term player. We need to focus on where original market. If we produce in Europe, we hire 10,000, 20,000 local job, then we become European manufacturer. We're part of this party.
There we go. That was Stella Lee, of course, the EVP of BYD. From one big interview to another, this one is coming up, as you can see on the Michelle Hussein show. Mark Carney, Prime Minister of Canada, the debut episode. Of course, their subscribers can find the full interview. You can catch this on the terminal, on the internet, on Bloomberg.com, and of course later on YouTube as well. So, that's it from us this week. Thank you for joining us these last 5 days. We'll see you all on Monday. Have a great weekend.